Let's go across. We have Venkatraman Narayanan, who's the managing director at Happiest Minds Technologies, joining us this morning. And we also have Joseph Anantharaju, who is the co-chairman and CEO at Happiest Minds, joining us this morning. Thank you so much, both of you gentlemen. Mr. Narayanan, let me come to you first. With regard to H1, it's been slightly disappointing compared to what one would have penciled in. Are you seeing an uptick in terms of how H2 is shaping up for you, or Q3 is shaping up for you? Are you seeing those trends getting any better, or is it still equally difficult and there is no change?
Thanks for that. In fact, talking about the first half, I think we have given a very good performance on a comparative basis, growing quarter over quarter. I mean, in 6.8% in dollar terms, and half year over half year, it's 11.8% growth. In terms of margins, we have maintained our EBITDA within the guidance of 20 to 22%, which is what we had said. And growth guidance was about in double digit, which is about 10% plus. And we are at 11.8% at the half yearly mark. So in terms of results, I think the first half has been good. It does set up the stage for our second half. We continue to hold on to the same numbers as far as guidance is concerned. We are seeing better market sentiments, improving market sentiments, and we did guide the markets or our investors to say that we will continue to hold on to the double-digit growth percentage in dollar terms for the year. And in terms of operating margins, it will be 17% plus and EBITDA will be 20% plus, given the way the markets are currently. We do see some headroom thanks to the way the rupee is moving. Obviously, we'll have to account for the foreign forwards that we have taken because we follow a simple ladder policy on the forwards. So net of that, we do see some bit of a gain happening given the way the rupee has been moving these past few days, which has been the news in the industry.
Right. Joseph, if I could get you in on the conversation. You've mentioned that GenAI services offer about almost $50 million plus revenue potential over the next 3 to 4 years. Are you seeing GenAI business cannibalize traditional services for you? Or do you think right now it's only incremental revenue on top of, cloud and SaaS?
So, I mean, if you look at GenAI and overall AI, you have to look at it from two viewpoints, right? One is the customer-facing and process-related automation and productivity that you can bring to the table. And that's one bucket. Second bucket, which is what you're kind of alluding to, is to what extent does it allow us to provide productivity-related enhancements to our customers from a coding and engineering perspective. So I think on both sides, we're making quite a bit of progress. On the first side, right, where we are looking at the actual objective of the generative AI business unit, which is to look at how do we take our customers' processes, their the way they do their work, and we had set ourselves a target of doing $5 million purely from GenAI. I'm not including any data or AI out here, which is separate and I would say the flow through. So I think we're going to exceed that $5 million for this year. We are one of the very few companies, probably the only company that has a separate GenAI business unit and calls out our revenues as well. On the other hand, there is productivity is concerned that we are looking at how to enhance productivity for our customers. We're making very good progress both on using a lot of the productivity tools and looking at an agentic AI approach for helping our customers with their modernization or with your greenfield development. But purely from a generative AI business unit, we are right on track to do more than $5 million that we had projected. I think we'll exceed that.
Okay, good to hear that. Also, Mr. Venkatraman wanted to understand BFSI, that still is your biggest business segment, yet softened in Q2 while healthcare and high tech improved. Tell me what's driving the dip in BFSI, and which vertical then would you think would be delivering the strongest margins for you going forward?
See, if you look at our vertical split, about a couple of years back, we were a strong edutech player. And since then, through organic and inorganic means, we have strengthened our presence in BFS and healthcare sector. In absolute terms, we have been growing in all verticals. Maybe there is a slight bit of softness in edutech over the last couple of quarters, where we are beginning to see turnaround. So all verticals, to put it differently, all verticals are showing growth. And we are seeing traction in all verticals. BFSI, it took us deeper in our Middle East business. Our Middle East business, the growth has been substantially coming, and all of it is BFSI. Our acquisition of Pure Software added a few accounts where we are going deeper. That's also BFSI. Artha Banking, the banking platform, the SaaS banking platform that we have, we are infusing AI capabilities into it, taking it into new markets. That's BFSI. So you see, we have got quite a few skewers as far as BFSI and our capabilities to grow in that segment goes. We continue to build traction in EduTech, which is where I think the focus has been, because there has been some softness in the market. We have been building on our capabilities and strengths and going back to the prospects and the existing customers that we have, so that we can go deeper into them. So in sum, I think we are seeing traction in all the verticals of our choice, which is primarily BFSI, healthcare, and high tech as well. We have to call out high tech and retail. Retail has been something which has been soft in the past, given the way the economy, the largest market of ours, which is US, has been performing. But we are seeing again green shoots in the other geographies that we have entered into with these vertical capabilities.
But Joseph, your top 20 clients contribute more than half of your revenue. Does the next phase of growth depend on reducing concentration or deepening relationships with these large customers?
I believe that it should be focused more on deepening our relationship with these customers, because all of them are most of them, I won't say all of them, are multi-billion-dollar companies, and they're multi business unit companies, and we can cut across, cross-sell, and have a larger presence in these companies. And I think if you look at our 10 transformations that we talked about, one of them was hypo, but I will also link it up to the NN sales that we pulled aside, which freed up time for our client partners, the verticalization that we did, that will allow us to understand the customer deeper. So I think putting all of this together, that's a very good question that you posed. My belief is that along with the acquisition of good NN clients, I think getting deeper into our top 20 customers, enlarging our presence, cross-selling, and becoming more strategic to them, I think that's the way to go forward, and that's what we would like to do.
Okay. Mr. Narayanan, if I can come back to you with regard to what the rupee depreciation means, is of course it's positive for you. It gives you a tailwind, at least in this quarter. But how do you plan to hedge the risks in case of a rupee pullback? What happens if the rupee strengthens, and how are you hedging for that risk? Because that's a very real risk for you if at all that were to play out.
So we have been having a simple vanilla, ladder structure as far as forwards goes. We have been following the same structure for the past, 11 years. We have not changed our approach based on how things have moved in the foreign currency market. We take 1 year forwards. It's based on 100% of the near term, the first 3 months, or 2 months, going all the way to 15% of the 12th month. It's a simple structure that we've been following. We have not been betting against currencies because we can't bet against currencies and rupee against economies. That's best left to the economists and the bankers. So we are doing what we can in terms of volume growth. But at the same time, the way revenue recognition happens, when you recognize revenues and you report in rupees, you do get the benefit of growth coming in from the weakening rupee. At the same time, we are protecting a large part of a possible pullback or a further depreciation through a calibrated approach of taking forwards. So we are happy that if there is any change, just like any exporter should be, weakening rupee does help us on our bottom line. But at the same time, we are hedged adequately to make sure that the pullback doesn't hurt us and take us completely by surprise.
Joseph, you want to add something to that, the currency risk, and especially with the way the dollar parity is currently on?
As Venkat mentioned, I think we've followed very prudent approach to how we manage our currency risk. And by and large, we've not seen any big impact. We've had, more often a positive impact based on, the approach that we've taken. And I think, even at a board level, we're very comfortable with the approach, that we've taken on hedging our foreign currency risk.
And Joseph, if I can ask you with regard to how you're seeing ordering traction build up. It was soft in H1. Are you starting to see a pickup? And give us also a sense, if there is a rate cut, do you anticipate a possible pickup in terms of ordering?
So, the last couple of months, we've seen some really, large opportunities and uh, prospects build up in our pipeline. And as we speak, we have at least 4 or 5, right off the bat, multi-million-dollar kind of deals from an NN or EN perspective, and 3 or 4 consolidation deals, which we normally don't see. As I've said in the past, that we are the space we play in is more of land and expand, but I think our size right now is getting us to a point where we're getting into a little bit more of these consolidation deals. So I would say that in the last 2 or 3 months, our pipeline has built really well. I think it's left to us now to make sure that we convert these deals, whether it's some of these NN larger size deals. There are a couple of them in the GCC space, and then 2 or 3 of these consolidation deals. So I think it's going to be an exciting, 1 to 2 months. And if we can pull off at least 2 or 3 of these, it'll set us up really well for next year.
And what do you make of utilizations, Mr. Narayanan? They've been maybe 78-80% odd. Do you expect those to inch up? And if that were to happen, how quickly will it happen? And how positively will it contribute to your margins?
So if you look at the utilization, we are currently at about 79-80%. It's got a few moving parts. The big one being the one favorable to us is the one on GenAI. So generative AI business services is currently the utilization of about 53-54%. If you look at on an annualized basis, there's only one way possible for that, which is up. If you pull that up to, let's say, 27%, it doesn't have too much of an impact on the overall company utilization, because we're talking about about 200 people, but it has a huge margin impact, because as you would have noticed, the GenAI business unit broke even in Q1. That was, I wasn't going hammer and tongs with that, because I wasn't sure if that would continue, but in half year, we have broken even, and now it's we have the conviction that it is on a trend upwards. So with both utilization improving and your margins improving and your recovery improving, and like we had talked about earlier, our pricing is likely about 20-25% at a premium to what we are doing in the other parts of the business. At GenAI services, what we are seeing is things looking better from here, and we are at that inflection point where things can only go up from here. Currently, 2.7% is the GenAI and AI business, contributes to 2.7% of our total business. And like Joseph mentioned, if it touches the 3% of the 270 or 275 million that we are doing this year, we are set up for a good year, that is of 2026-27, and it also takes our utilization slightly up and also helps in our margin play.
It's very interesting that you say that, Mr. Narayanan. And let me maybe follow up with one more question. GenAI at 2.5% of revenue, isn't it slightly less? Would you expect a sharp inch up maybe? And if so, when? And say by the time you hit $1 billion in revenue by the end of this decade, what would that GenAI component be? Give us some color on that.
Just on the mathematics of it, yeah.
Let me take that actually.
Yeah, sure.
So I think one thing we have to look at is how people report AI business, right? And we are reporting pure GenAI business. I want that, I want to be clear on that. The $5 million, and I think we'll exceed that actually. But we'll wait till end of the year. It's pure GenAI business. Outside of that, we have AI, data, analytics, AI, ML business that is quite substantive, and we don't include in this. We're quite bold in having this as a separate business unit because internally as well we wanted to be accountable, saying how much do we do from GenAI, because I think it's quite different from your traditional AI where it is more algorithmic and AML driven, and therefore I think I don't know how the other companies report their GenAI revenues. Most of them I've seen report a broader AI, and we don't know what is included in it. And I think the 2.5% we're reporting right now is a pretty good number, and we expect that to go up. As we said, including all our replicable sales and other use cases and other things that we have put together, we expect this to become 5% or $50 million in the next 5 or 6 years. And I think that's a pretty substantive number, if you ask me. Venkat, you can add on to this, Venkat.
No, I agree with you, Joseph. In fact, we may be the only company which reports generative AI as a separate BU. You have most companies saying, hey, we have signed up $100 million deals, which is AI-led or Gen AI-led. We don't get into that sort of a distinction because almost all the new deals that we are winning today is AI-led and has a huge impact from the Gen AI capabilities that we position in front of our new business. So, just to talk about it, we talked about $8 billion of new business that we closed in the first half of this year, 30 new logos. Almost all of them, if you look at it, has had a Gen AI component. And today, our presentations start with our AI capabilities, how we can make sense of the new Gen AI tools that are available, tools and technologies are available to make the digital transformation really work for our clients. It's all generative AI and AI-led. When it comes to revenue, bucketing it into revenues, we have been a little conservative and only pulling and showing generative AI the 2.7% that I talked about.
Yeah. And last point I wanted to just add to what Venkat said, is that if you look at our, our testing space or our overall software lifecycle, or even our L1, L2 support, we've infused a fair bit of Gen AI into the process as such, right? Our test automation right now is Gen AI driven. If you can just get the requirements from a customer, we can feed that into our engine and push out test cases and then automate those test cases and execute those test cases. We don't count that in Gen AI business, but it's all based on Gen AI. If you look at L1, L2 support, we have our own platforms that we built using Gen AI engines that automate 80-90% of L1, L2 support. And that's a productivity enhancement we pass on and cost optimization we pass on to our customers. We're not including that into Gen AI, right? So I think it's how you measure Gen AI. If you put all of this, our AI revenue would be much higher. That's what I want to leave you with, actually.
But since we're talking about it, Joseph, and this is a new subject to all of us, so just just for our understanding, the belief is that more than revenue, it's the margin contribution when it comes to AI you know, I mean, in terms of margin contribution is much higher than revenue contribution. Is that a fair assumption or understanding?
So again, I'll be quite honest with you. It depends on which space you see. Right? If I'm working with a customer on automating their process, and if I can do it, on an outcome based, I think there I'd be able to gain some margin contribution and give some to the customer. Similarly, on the software life cycle, whether it's testing or coding, right? If we can do it more on outcome and fixed price basis, you'll be able to get some benefits out of the productivity enhancement and pass on some to the customer. And what we are working towards with our customers is to see how we can take a little bit of risk from saying that, hey, we'll be able to do to deliver this outcome to you, and and get into a little bit more of an outcome-based pricing that will allow us to share some of the benefits of the productivity enhancement. I think that's what we're working towards. It's a little bit of a balance thing, actually, if you ask me.
Okay, understood. Maybe we should have a longer show on how to analyze AI and how it really translates into balance sheets.
Maybe next conversation.
Done thing. But great to have you both. Thank you so much for your time. And Joseph, thanks for staying up. I believe you're joining in from Seattle.
Thank you. That's right, yeah.
Okay.
Thank you very much.
Right.
Nice talking to you. Bye-bye.